For those of us who have spent decades in the markets, there has always been a fundamental comfort in the hard asset. A skyscraper, a multifamily complex, a logistics hub, these are tangible. They are governed by the laws of physics and the steady, predictable rhythms of local geography. We've been trained to believe that if the roof is sound and the rent roll is full, our equity is secure. But recently, a quiet tremor moved through the foundation of the industry, not a physical one, but a digital one. Bloomberg recently reported that the FBI and several major banks have begun assessing a significant hack of a key real estate finance tech vendor. This wasn't just a localized glitch. It was a systemic breach into the nervous system of property finance. It serves as a stark reminder that in the modern era, a physical asset's value can be paralyzed, or even erased, by a digital breach. We are entering a period where the digital perimeter of your portfolio is just as critical as the physical security of your buildings. Today, we aren't looking at the sensationalism of cybercrime. We are looking at the structural fragility of our capital. When headlines like the Bloomberg report break, the immediate reaction from the mainstream media is one of shock and alarm. They focus on the who and the how of the hack, the shadowy actors, and the clever code. But for the seasoned investor, that is noise. As we analyze this event, we must look past the headline. This is not merely a hack story. It is a structural risk story. We have spent the last 15 years optimizing for efficiency, moving our debt servicing, tenant management, and valuation models into the cloud. In doing so, we have traded resilience for speed. The sobering reality is that we have become dangerously dependent on a handful of third-party vendors who now hold the literal keys to our real estate data. When a vendor fails, the asset doesn't disappear, but the liquidity and the transparency of that asset do. If you cannot verify your debt covenants or access your rent rolls because a vendor's server is dark, your equity is effectively frozen. This is the new face of counterparty risk, not a bank failing to pay, but a vendor failing to protect. To understand how we got here, we have to look at the evolution of trust. If you go back 20 or 30 years, real estate was a business of localized, institutional trust. It was a world of handshakes, physical ledgers, and local bank branches where the manager knew the property and the borrower. Risk was contained within a geographical and social circle. Today, that world is gone. We have transitioned from handshakes to APIs, application programming interfaces. We have globalized and digitized the tech stack of real estate finance to allow for massive scaling and instantaneous reporting. But our risk models haven't kept pace with this shift. We are still performing due diligence as if we are in 1995, focusing on the cap rate and the physical inspection, while ignoring the fact that the entire investment is now sitting on a digital perimeter that we neither own nor audit. We have outsourced our trust to software-as-a-service platforms, assuming that because they are institutional grade, they are invulnerable. The Bloomberg report proves that institutional is no longer a synonym for impenetrable. So how do we define this digital perimeter? As an analytical investor, you need to see your portfolio as a software stack. At the base, you have the asset, but layered on top of that asset is a complex web of third-party providers. There is the debt servicing platform that handles your interest payments and monitors loan-to-value ratios. There is the property management software that stores the personally identifiable information of every tenant, a massive liability in itself. There are the valuation engines and the investor relations portals where your GPs report your quarterly returns. Each of these is a potential point of failure. The most significant vulnerability lies in what I call vendor monocultures, where a single software provider becomes so dominant in a niche like real estate finance that their failure becomes a systemic event for the entire sector. When the FBI has to step in to assess a vendor, it means the perimeter has been breached at a level that threatens the broader market stability. For the man over 40 who is focused on capital preservation, the question is no longer, is the asset good? But rather, is the infrastructure holding the asset secure? This centralization is the crux of our problem. We've been told that moving to the cloud increases security, and in many ways it does. Professional data centers are far more secure than a server in a basement. However, this creates a new type of concentration risk. If 5,000 real estate firms all use the same debt servicing vendor, that vendor becomes a high-value target for state actors and sophisticated criminal syndicates. The Bloomberg report suggests that banks are now realizing this. They are assessing the blast radius. If one vendor goes down, how many billions in loans are suddenly obscured? How many margin calls cannot be met because the data is unavailable? This is where the deep dive begins. We must move toward a verify, then trust framework. We can no longer take the SOC2 report of a vendor at face value. We need to understand their redundancy protocols, their disaster recovery timelines, and most importantly, who has the keys to the data when the lights go out. Equity protection in 2024 is as much about cybersecurity as it is about interest rates. In our next sections, we will move from this diagnosis to a prescription. We will analyze the cascading failures that occur when vendor monocultures collapse and how you can structure your future investments to mitigate this. But for now, I want you to sit with this realization. Your due diligence process is currently incomplete. If you are not auditing the digital infrastructure of your GPs and their third-party partners, you are flying blind through a storm. The horizon view is one of sobriety. We don't panic, but we do prepare. We recognize that the world has changed, and our methods must change with it. The era of blind institutional trust is over. The era of the security protocol has begun. To understand the new era of the sovereign power producer, we must first look at the structural inefficiency of our current electrical grid. For decades, utilities have struggled with the duck curve, the massive surplus of energy generated during the day that vanishes the moment the sun sets. Historically, this surplus was wasted or sold at negative prices. But we are witnessing the birth of compute energy arbitrage. By placing high-density compute, whether it's Bitcoin mining rigs or AI inference clusters, directly behind the meter at the source of production, we are no longer just generating power, we are monetizing the physics of the grid itself. These facilities act as interruptible loads. They consume the surplus when it's cheap and plentiful, and switch off instantly when the grid faces a peak. For the long-term investor, this is a fundamental shift. The power plant is no longer just a utility. It is a financial mint. It converts excess electrons into globally liquid digital assets or high-margin compute cycles, creating a floor price for energy that never existed before. This isn't speculative. It's an optimization of the most important resource in the history of civilization. For decades, the bedrock of real estate investment was institutional trust. You trusted the GP because of their track record. You trusted the bank because of its balance sheet. But the Bloomberg report changes the calculus. Trust in its traditional form is a vulnerability. We must move toward a verify, then trust framework. This is a new protocol for the disciplined investor. It means that during the due diligence process for a REIT or a private equity fund, we are no longer satisfied with just looking at the cap rate or the debt-to-equity ratio. We must now demand a digital audit. What does this look like? It means asking the general partner, GP, difficult, technical questions. Who are your third-party vendors? What is the frequency of their penetration testing? Do they have a SOC 2 Type 2 certification, and more importantly, have you personally reviewed it? We are shifting our focus from the physical integrity of the building to the digital integrity of the ownership record. If a vendor failure can lock you out of your rent rolls or freeze your ability to service debt, then that vendor is a material risk to your equity. In this new era, due diligence that ignores the tech stack is, quite frankly, professional negligence. We are not tech experts, but as fiduciaries of our own capital, we must be informed enough to verify the safeguards of those who handle our data. In the wake of the FBI investigation, we have to talk about mitigating the unthinkable. Disaster recovery used to mean having a backup generator and insurance for fire or flood. Today, disaster recovery means ensuring the continuity of your equity in the event of a total vendor collapse. When we analyze the Bloomberg source, the real fear isn't just a temporary outage. It's the corruption of the underlying data. Imagine a scenario where the digital ledger of who owns what and who owes what is compromised. To protect your capital, you must demand transparency regarding data redundancy. I advise my peers to look for sovereign data protocols. Does your GP have an offline, immutable backup of the critical portfolio data? If the primary vendor goes dark, how quickly can the fund switch to a secondary system to maintain debt service? This isn't about paranoia, it's about structural resilience. We structure our deals with legal protections and waterfalls to handle financial stress. We must now structure our investments with digital fail-safes. The goal is persistence. Your equity must persist even if the software managing it ceases to exist. This requires a shift in how we contract with managers. We should be looking for GPs who treat their digital perimeter with the same level of scrutiny they apply to their title insurance. As we look toward the horizon, we see a landscape that is fundamentally different than the one we navigated 10 years ago. The Bloomberg report on the bank and FBI assessment is not a reason to retreat from real estate finance. It is, however, a clear signal that the rules of engagement have changed. The investors who will thrive in the coming decades are those who recognize that hard assets are now irrevocably tethered to soft infrastructure. We don't panic, but we do prepare. We recognize that the era of blind institutional trust is over, and in its place we are building a more rigorous, intellectually honest framework for capital preservation. By implementing the security protocol, by auditing our vendors, demanding data redundancy, and verifying the digital perimeter, we aren't just protecting our equity. We are creating a competitive advantage. In a world of systemic fragility, Resilience is the ultimate form of alpha. Those who fail to adapt will remain exposed to the next vendor failure, the next headline, the next investigation. But for those of us who prioritize the long-term sustainability of our portfolios, this is simply the next evolution of the craft. The horizon remains clear for those who have the vision to see the risks as they truly are. Stay analytical, stay calm, and as always, keep your eyes on the long-term horizon.